SBI, Mr. Sethi, MDs, members of the board of SBI, esteemed industry leaders from the banking and finance world, media, ladies and gentlemen. I'm delighted to be here as always in this SBI Banking and Economic Conclave. I thank the chairperson, SBI, and the whole SBI family for giving me this opportunity to be here. This conclave comes at a time when there are unprecedented uncertainties, geopolitical tensions, technological disruption, and so this is very timely. It affords us with an opportunity to dwell on what the challenges are, and at the same time what this offers to us, more importantly I would say in terms of the opportunities. I recall about a year ago when I spoke at this particular conclave virtually from North Block. I talked about the reforms that we carried on in the taxation sector. And today I stand here before all of you to talk about some of the regulatory changes that we have brought out in the last few months. You are aware that earlier we had issued a regulation-making framework for RBI, in which we have a consultative process. We are trying to make it more open, more consultative, more data-driven, more evidence-driven. And so we do a consultation, a public consultation, which has been formalized in the framework. We set out the objectives of the regulations, and we do an impact analysis. So in line with the same spirit which has been given there in the framework, I propose today to shed some more light on the objectives and the rationale for some of the important measures that we have taken in the last few months. To set the context, I would like to reiterate what I said in my first MPC statement in February this year, and whatever we have done in these past few months, including the last MPC statement, is in line and consistent with what I had said in my first MPC statement. I would reiterate that, and I had said that the interest of the national economy demands financial stability. For us in the Reserve Bank, this is the guiding principle. This is the North Star, because short-term growth, which is achieved at the cost of financial stability, can have bigger consequences for longer-term growth. Research shows that financial instability may not only more than offset the gains of short-term accelerated growth, but may also make recovery more distressful and longer. At the same time, economic interest warrants increasing efficiency and promoting innovation, which also is the duty of RBI. We recognize that just like there are no free lunches, regulation to enhance stability too is not devoid of costs. There are trade-offs between stability and efficiency, and I had assured that we will keep this trade-off in mind while formulating our regulations. I had mentioned that it will be our attempt to strike the right balance, keeping in view the benefits and costs of each and every regulation. The recent regulatory proposals strive to attain that balance between the drive to innovate and grow on the one hand and the duty to protect. Moreover, in a rapidly evolving banking system, underpinned by technological advancements of tectonic magnitude, no regulator can afford to situate the system at a point of time. The role of the regulator is to guide its evolution within guardrails that ensure stability, fairness, and resilience. In India, this philosophy has found steady expression in RBI's approach towards regulation, what might be called responsive conservatism, a model that prizes stability yet remains open to reform, change, and improvement. In this context, while all of you are aware, you are all veterans in this field, but I think it would still be germane to briefly recap the developments of the past decades in the financial system, in which we have made huge strides, as you are all aware. SBI has become a $100 billion bank. That is also part of this journey. So post the GFC, in the wake of aggressive fiscal and monetary stimulus, the ensuing regulatory forbearance sowed the seeds of the twin balance sheet problem. Over-leveraged corporates and stressed balance sheets of the banks. Coupled with the manifestation of external sector vulnerabilities, India got clubbed amongst the so-called Fragile Five. Guided by the principle never to waste a good crisis, the period from 2014 led to a foundational surgery to restore the long-term health of the financial system. This was driven by a series of regulatory measures aimed at recognition, resolution, and recapitalization of the banking system. The AQR, initiated in 2015, compelled banks to recognize the true state of their loan books, bring hidden NPAs onto their balance sheets, and significant improvements were also brought about in the supervisory framework. Simultaneously, the Prompt Corrective Action Framework, the PCA framework, helped restore the health of weak banks. It was followed by consolidation of 27 public sector banks into 12 by 2020. These measures, complemented by massive recapitalization program, strengthened the balance sheets, the capital buffers of the banks, and restored their capacity to resume healthy lending. SBI chairperson was just now mentioning as we entered that in 2018, they were in a loss. And today they are a $100 billion company. The introduction of IBC in 2016 and the pursuant resolution paradigm introduced through out-of-court workout mechanisms have fundamentally transformed India's credit culture. Parallelly, major reforms were taken to strengthen monetary as well as macroeconomic stability. This includes the adoption of the flexible inflation targeting regime, the deepening of the forex markets, and the gradual liberalization on the capital account. The recent past has also seen a number of transformative measures. Financial intermediation has now become a sophisticated and layered system. There are nimble fintechs and NBFCs that assume a greater role in origination. Development of capital markets and credit risk transfer channels such as securitization now provide a conduit for risk transfers. The project finance directions issued recently address risks arising from regulatory approvals and availability of land, etc. The proposed forward-looking ECL provisioning will force earlier recognition of the deterioration in asset quality and provide for appropriate loss buffers. Moreover, all of you are aware, Indian banks today are far more mature than they were a decade ago. Credit and deposits have expanded almost 3 times. capital buffers to have strengthened. The CRAR has improved by about 4% from 2015 to 2025. Similarly, the CET1 has increased from 10.43% to 14.73%, an increase of 3.4%. Asset quality has improved, GNPA and NPAs have decreased, profitability has improved, return on assets, return on equity, all have jumped. 17-18, it was negative, as was that of SBI. To give you some numbers, return on total assets was negative 0.24 for the bank, for the scheduled commercial banks in 17-18. And that's not very long ago. And today, it's 13 points. Last year, it was 13.7%, and it has been consistently positive and in double digits for a very long period. So regulation cannot ignore these developments, this performance, these changed realities. This evolution implies that the prudential rule books too should evolve in a calibrated manner as banks are now stronger, supervision more alert, even as alternative risk-bearing pillars have deepened and market-based risk transfer has become more effective. The recent regulatory measures need to be seen in the backdrop of these developments which have shaped the banking industry and the financial system over the last decade. Let me elaborate on a few measures. First of all, I'll speak on the draft guidelines on the capital market exposure. The proposals to enhance the limits for lending to individuals against securities and rationalize the norms for lending to capital market intermediaries are part of the normal process of review, seeking to reset the limits which were set way back 26 years ago in 1999. Importantly, the revision in limits has been accompanied by a more structured LTV framework, which is sensitive to the risks of the underlying securities. The proposed removal of limits on loan against debt instruments while retaining the regulatory limits for equity instruments recognizes the fundamental difference between these two, equity and debt, from a risk perspective. The key risk a debt instrument carries is credit risk, and just like loans, credit risk is expected to be managed as part of the broader credit risk management framework. An additional comforting factor that has been brought in these regulations is that only listed and investment-grade debt securities are proposed to be taken against collateral for these loans. This rationalization is expected to foster a virtuous, positive feedback loop for the development of the bond market. As regards acquisition finance, which is also part of the CME, this is acknowledged worldwide as an integral element of an evolved financial system that helps in better allocation of financial resources. And recognizing this need even within our own country, non-bank players such as the NBFCs and the bond markets are already allowed to provide such funding. Removal of the restriction on the banks will benefit the real economy, and these come, as you are aware, as the draft puts out, with guardrails like limiting bank funding to 70% of the deal value, limits on debt to equity ratio, aggregate exposure limits relative to tier 1 capital of the bank, eligibility criteria, etc., which will ensure safety while allowing banks and their stakeholders to reap benefits of additional business. Let me now turn to the withdrawal of the specific borrower framework, which was introduced in 2016. 2016. This framework was instituted in a very, very different financial environment, as I just mentioned, when the banks were almost reeling under losses. This was a unique measure, which perhaps to our knowledge, no other country has ever implemented at the bank level, at the system level. At that time, the banking system was grappling with elevated levels of stress, which no longer is the case. The tier 1 capital of the banking system as a whole was only about 8 lakh crore rupees. Today it is 26 lakh crore rupees, 3.2 times, more than 3 times what it was. On the other hand, the overall share of exposure of the banks to the corporates has considerably reduced. The regulatory landscape, as mentioned earlier, has evolved significantly. The large exposure framework, which is aligned with international best practices, is now well established. The supervisory toolkit is vastly improved, and therefore it is proposed to substitute the blanket risk weights and provisions in the extant framework with better monitoring and risk management by the banks. Coming to risk weights for infrastructure exposure of NBFCs, I would like to highlight that the proposal seeks to prescribe risk weights on the basis of the risk profile of the exposures. However, certain conditions have to be satisfied to qualify for the lower risk weight. One, there is a set of qualitative criteria that has to be fulfilled ab initio. The details are there in the guidelines. And two, a principal repayment criteria that would demonstrate a reasonable performance track record before the risk weights can be lowered. As regards the ECB external commercial borrowing framework, these measures come against the backdrop of a strong external sector. India's current account recorded a surplus of $13.5 billion in the last quarter of the last financial year. This is 1.3% of our GDP. Even the first quarter of this year, we had a modest deficit of only about $2.4 billion or 0.2% of our GDP. The foreign exchange reserves, all of you are aware, are very healthy. Even on the capital account, the flows are very robust. Net inflows to India under the foreign investment, ECB and NRI deposits, in fact, were higher in the first quarter by almost about $4 billion. This stood at $30.4 billion as against $26.8 billion in the period April to July. Our projections show that the capital flows will remain quite strong even during the rest of the year. The calibration of the ECB framework, therefore, is a natural step in India's financial evolution, grounded in strong fundamentals, guided by prudence, and inspired by confidence in the economy's capacity to engage with global finance on its own terms. The removal of all-in cost ceilings will encourage competitive rates and promote prudent hedging behavior. Expansion of the universe of eligible lenders will improve pricing efficiency. Linking the borrowing limits to the borrower's net worth under the automatic route links ECB to the strength of the borrower while enhancing ease of doing business. This limit and the overall soft ceiling of total outstanding being 6.5% of the GDP will mitigate the risks, if any, of excessive external leverage. Moreover, I wish to clarify that ECB will be permitted only for FDI compliant real estate projects and remain prohibited for speculative dealing or loans for land or property trading. To summarize, all these measures are balanced and appropriate, built on the bedrock of a banking system that has been systematically fortified over the last decade, with financial stability remaining the unwavering cornerstone of our policy architecture. All these changes are incremental in nature, and I quote what Shakespeare said, "We are moving wisely and slow. They stumble that run fast." At the same time, while we move with caution, we need to display courage. And again, I am reminded of Shakespeare. It's dangerous to take a cold, to sleep, to drink. I repeat, it's dangerous to take a cold, to sleep, to drink, to do normal activities is also dangerous. But out of this nettle danger, nettle is a plant which has some thorns, etc. But out of this nettle plant, which has danger, we pluck this flower, safety. So these measures do reflect some fresh thinking, but they are incremental and they do not introduce any sea change. Moreover, no regulatory measure, as I mentioned earlier, can be understood in isolation. Each measure has to be seen in the continuum of regulatory evolution and not in isolation. These proposals must be read against the broader regulatory scaffolding which mitigates all these risks. Together, the regulations create a multi-layered defense to keep systemic risk in check. Analyzing merely one regulation without understanding the complete regulatory landscape risks missing the forest for the trees. Let me highlight that the higher responsibilities placed on the banks are based on their past performance. This is on account of improved governance, prudent decision-making by the banks over the last decade. As highlighted earlier, capital buffers are stronger, asset quality better, profitability much improved. Regulation has evolved, regulation therefore has to evolve, keeping in mind the realities of time and the performance of the banks. Moreover, no regulator can or should, as far as possible, substitute for boardroom judgment. Especially in a diverse country like ours, each case, each loan, each deposit, each transaction is different risks, different opportunities. We need to allow the regulated entities to take decisions based on the merits of each case rather than prescribing a one-size-fits-all rule. This will enable regulated entities to experiment and innovate, to learn and improve. At the same time, wherever we have allowed hitherto prohibited activities or reduced restrictions, or we have proposed to reduce them, we have provided, as mentioned, sufficient guardrails to ensure safety and prudence. I may also mention that the role of a regulator does not end just by providing the regulations. His role is like that of a gardener whose job does not stop with providing the enabling framework. The gardener keeps on monitoring the growth of the plant and prunes unwanted growth to shape a collective, orderly, beautiful garden. RBI has ample tools, risk weights, provisioning norms, countercyclical buffers to contain emerging risks. History shows our readiness to act, as was seen most recently in November 2023 when we raised the risk weights for certain types of consumer credit. Needless to say, therefore, supervisory action have enabled effective backstops to moderate or prune unsustainable growth and shape a robust, resilient, and beautiful banking system. Finally, let me emphasize that most of these regulations, measures that we have put in place, they are draft, even though they have been issued after great deliberation, thought, and a pre-consultative process. And while they do reflect the broad direction of the regulations, they are not final. We will take inputs from all stakeholders and we'll finalize them basis those inputs. Before I conclude, let me also touch upon some of the changes introduced with respect to consumer grievances. The Reserve Bank has maintained a persistent focus on enhancing customer service standards and strengthening grievance redressal systems. Recently, in the last few months, 2 campaigns, one has been already organized, and the other one, the first one relating to financial inclusion has been already organized, and the other one now related to unclaimed deposits is in progress. Good work has been done by the banks, and I'm sure they will continue the good work in this regard. And so in this direction, we have now put out 2 regulations, one for the internal ombudsman and the other for the RBI ombudsman scheme, which are being proposed to be refined to further improve and enhance their efficacy. It is imperative that the regulated entities too address consumer grievances through mechanisms that are fair, transparent, timely, and without undue cost. The regulated entities may kindly assess the quality of customer service through periodic and regular thematic studies. Effective root cause analysis of the complaints may also be conducted to identify systemic issues so that such complaints and grievances do not arise in future. I would request all the MDs, CEOs, senior management present here and listening for their full support and their attention in ensuring that the proposed changes, once finalized, are implemented not only in letter but also in spirit. To conclude, I would like to emphasize that our approach is calibrated, granting banks greater commercial leeway for growth, innovation, and ease of doing business, while ensuring that the risks to the banks are minimum and financial stability is ensured. We have set ourselves an ambitious goal of becoming a developed country by 2047. The financial sector has a big role to play in it. RBI remains committed to this goal. We will ensure that our financial system evolves responsibility to support innovation, growth, and the long-term resilience of our economy. I'm sure that the deliberations in this conclave will help in taking this developmental agenda forward. I commend SBI for this initiative, and I wish the conclave a huge success. Thank you. Jai Hind.